Thank you very much, and I'm glad to be here. This event reminds me slightly of when I was president of Harvard University, in part because we had a dinner after my inauguration in this very room, which is one of Harvard's finest, and in part because part of being a university president is that you're called on frequently to speak to all kinds of groups, the wrestling team, alumni, the string theory colloquium, the Christianity renewal at the Divinity School. And what all those events have in common is that everyone in the room has more expertise in the subject than you do. And that is the case tonight, as best I can tell. Everyone in this room is an expert on some aspect of corporate governance and has written and done scholarly work in that area. And I cannot claim to be an expert, which makes me slightly wonder why Alan has invited me. But I am not known for excessive modesty, nor for declining alternatives to speak. So here I am. And I thought that given that you all have been discussing many complex and nuanced and subtle things all day, that perhaps the most useful thing I could do for 15 or 20 minutes was imagine that I was sitting with the President of the United States, and not the current one, I hasten to say, and the President of the United States asked me various questions and said, what do you think about this? What do you think about that fall within your remit, and encouraged me to give on the one hand, on the other hand, answers. So I'm going to pose some questions and tell you what I think, though in every case, almost every case, I don't have enough confidence in my opinion that I couldn't imagine changing it in the face of the kind of research being reported at this conference. First question. So Larry, isn't it a big problem that companies are myopic because stocks turn over so fast and shareholders are in a hurry to make a quick buck, and so they make companies be myopic? And isn't that really holding back our economy? And that doesn't happen as much in China, and they've got more rapid productivity growth. And so shouldn't we do something like maybe make the capital gains tax rate lower for people who hold stock for a long time? No, Mr. President. I actually know that that's a very popular idea, but I think there is no evidence for it and a lot of evidence against it. To start with, we've got a huge, thriving, successful venture capital industry in America that gives money in substantial quantity to companies that have no profits, have no sales, and in some cases, have no plans. And if there was a big myopia problem, people who went into solving it would on average make money. And the fact is that the venture capital industry on average loses money substantially. Moreover, Mr. President, do you know about Jeff Bezos? He's got a rather valuable company. His strategy is to not worry about current earnings and to hold out for future prospects, and it seems to have worked out rather well for him. Mr. President, you know, if it were really true that the market was systematically myopic, then you'd expect that the companies that were generating a lot of cash flow real fast would be overvalued, and the companies that weren't generating cash flow would be undervalued. But, Mr. President, it's the most well-known fact about the stock market and the key to Warren Buffett's success that it's exactly the opposite. The companies that are generating high cash flows relative to their price are undervalued, and you make money by investing in them. But Larry, what about that McKinsey study? The McKinsey study that showed that companies that took a long-term view did better than companies that took a short-term view. Well, Mr. President, it was a stupid study. And the reason it was a stupid study was that people who have investment opportunities invest, and people who don't have investment opportunities don't. And so when you observe that people who have investment opportunities grow and invest a lot, grow in value more than people who don't have investment opportunities, it proves nothing. Why do all these CEOs always tell me that this is such a big problem? Well, Mr. President, students always tell me that grades are a real bummer. That if there weren't grades, they'd be able to pursue their intellectual passions rather than study the stuff they need to learn for the exam. And some of them are right, and grades sometimes do distort things. But on balance, I think if there were no grades, there would be a little more intellectual creativity, and there'd be a lot more beer consumed on college campuses. And so, of course, CEOs would prefer to be able to grow their institutions and spend money and control money rather than giving it back to shareholders. We all have those kinds of preferences, but we shouldn't confuse that preference with evidence. Yeah, but isn't it true that companies on average, sometimes when they're private, invest more than companies when they're public? Yes. There's no way, Mr. President, that Theranos would have been able to raise $900 million as a public company. People would have shorted it, people would have studied it, people would have investigated it, and they would have figured out 4 years earlier that it was fraudulent. And so, yes, there are people who get to invest more because nobody's watching and evaluating the investments except them and a few of their friends and the few people who are most optimistic about them. But you don't let the most optimistic general get to set the battle plan here. And why would you think that letting the most optimistic person make a judgment about how much was going to be invested in any given area is a good idea? And by the way, 85% of corporate shares are owned by people who don't pay capital gains taxes. And so if you do the capital gains idea, you're going to have no effect on corporate behavior. And what you're mostly going to do is give huge rewards to people who've invested in real estate, oil and gas, and other kinds of illiquid tax shelters. And I can't imagine why you would want to do that. Long-termism lack of long-termism caused by corporate myopia is not one of America's 100 biggest problems. Well, surely all these activists running around are a big problem, Larry. It can't be a good idea to have all these guys who, work with Lucian Bebchuk and stuff and hassle and, I was just talking to Marty Lipton he's right that these guys vipers who don't care about institutions, and they really ought to get controlled more, shouldn't they? Well, I think that's a very hard question, because I think there are some real issues around implicit contracts. Sometimes companies are made more efficient by new management that sets new requirements. And sometimes they're just made more ruthless and more hard-nosed. And if you increase share prices by being better at paying workers less, that's not necessarily a major source of efficiency. And so you do have to recognize that the ability to hold an institution together is often an important asset. And if you make institutions too vulnerable to the immediate, you can have a problem. And so that's an area where we probably do need to strike a balance. But you know, you can debate how well the American economy is doing relative to the European economy or the Japanese economy or other economies. But as all your rhetoric, Mr. President, about outsourcing suggests, American companies are doing extraordinarily well. 40 or 50% of their profits of the 500 largest American companies are earned abroad, and a comparable fraction of their sales are abroad. So if you look at the success of the American corporation as an institution, it has fared much, much better than the American economy as an institution. Now, that is a huge social problem, and we are all here to make the American economy function better, not to make S&P 500 corporations function better. But if the argument is that somehow our governance institutions over-empower shareholders, and that it's better to disempower shareholders, even new shareholders, we'd better look hard at the places that do a lot of that. And I'm not sure which one of them is producing corporate institutions that are highly successful in driving progress and driving prosperity around the world. So yes, I think there are excesses of activism, and I think it's worth looking at some ways of doing that. I think in particular that we've got a big bias in the tax code towards debt, and when there's pressure to take more advantage of that, that leads to a variety of distortions. And I think we should think about how we're treating interest deductibility. I think we should think in particular about how we treat extra debt burdens taken on to support share repurchases. But I think we've got to be very careful about disempowering shareholders, since our corporations really have been remarkable and effective institutions. What about this idea, Larry, of common ownership? You know, I was reading about it. They're all talking about it like it's one big conspiracy. It like reminds me of Marx when I read it in college. It says that like BlackRock and Norway and these same people, they own all the companies, and so they make all the companies work together, and all the people are getting screwed. Isn't it really terrible? I don't know. It's probably the newest idea that is getting a lot of discussion among the academics and scholars who work in this area, and I don't think it's fully processed yet. And there are some conceptual issues there. It is true that if you're running General Motors, you're not trying to get Chevrolet and Cadillac to compete against each other as hard as you can. And if the same people own Ford and GM, and they're really the same people and they're highly empowered shareholders, why should they want Ford and GM to compete with each other? It's kind of a compelling, logical argument, and maybe it explains some things. But I don't think most people who've seen how actual companies are run think that any of that stuff is particularly prominent around the boardroom. And even if it were around the boardroom, whether it would successfully find its way down to the level of divisions. And look, there was some study that was done that people are talking a lot about some bunch of airlines, and somehow when there was a high correlation, you know, when Delta and Northwest were on a, Delta and American were on a thing, and they had more common ownership than American and United, then somebody managed to find that the price was a little higher. Like, get a life. I mean, if you just know how the prices in those firms are set, it is highly implausible, to put it mildly, that the people doing the Cincinnati, Minneapolis route are able to figure out whether the at Delta are thinking about, we're going to think about it differently because it's American and United, and we've got 4% more common ownership with United than we do. It just defies the belief of everyone I've talked to who's been anywhere near actual airline pricing. On the other hand, at some point, could this be a problem as we have more and more index funds, and the more and more index funds talk to each other? Maybe it could be. And it is true that the business community does have a policy that they don't criticize each other. So when somebody's looking for a tariff protection, the rest of them are free traders, but they'll never dump on the guy who is looking for the tariff protection. And they'll all support each other's tax breaks. So maybe there is some broad sense in which we're all in this together. And I think it's a real question that the SEC ought to think about. A woman named Dorothy Shapiro, and probably a bunch of others, has written about whether index funds should be involved in trying to vote their shares. They're not going to leave. They're supposed to be trying to provide a maximally cheap product for consumers. Why they own everything. Why wouldn't it be better if they just stayed out of corporate governance? And maybe that's a good idea. Don't know enough to endorse it, but that's something that I think is worth thinking about. But the general idea that all of capitalism is now organized as a conspiracy because BlackRock has index funds and Norway owns 5% of every company feels pretty unlikely to me, like it's the right way to understand the world. Well, what should we do about all these foreign countries who are owning our companies? It's one thing if some foreign company buys one of our companies. It's one thing if some rich guy makes a big investment in one of our companies. It's one thing when GE makes an acquisition in France. But what should I think when Singapore's making investments that buy our banks, or China's buying up our natural resources, or Dubai was years ago buying up our port? You know, you used to work at Treasury, Larry, and those CFIUS guys, like, they call it the Committee on Foreign Investment in the United States, but it's really the Committee to Promote Foreign Investment in the United States. They never stop anything unless the Defense Department or somebody else makes them. Isn't that really kind of wrong? Look, for the most part, it's kind of a good thing. If they put their money buying Rockefeller Center, we still own and control Rockefeller Center. And if we ever wanted to, in extremis, we could just say, it's ours and we're not going to pay you anymore. So by and large, if we get the right to buy a lot of stuff from them, and all they get is a claim on stuff that's here that sort of functions ultimately at our discretion, that's kind of a good thing for us. We like to create jobs here, and more people will invest in more stuff if the interest rate is lower and the stock market is higher, and if a bunch of foreign money is allowed to come in. That's more likely to happen. You know, there's an old line, would you rather live in a country the capital was trying to get into, or a country the capital was trying to get out of? And I kind of would rather live in a country the capital was trying to get into. So as a general matter, the people who thought it was terrible when Japan bought Pebble Beach 25 years ago look stupid today. And the people who are worried because China bought the Waldorf Astoria will look, I'm pretty confident, similarly stupid in the passage of time. But I think there are three real issues with foreign investment that you should ask your Treasury Secretary and your other officials, Mr. President, to think about very hard. One, where if it were up to me, you'd end up deciding to do very little, but it's a complicated issue, is reciprocity. If other countries aren't letting us buy, should we still let them buy? And I'm inclined to think the answer is yes, because I'm not sure it's that great for the average American worker when we buy things abroad. And I think it is good for the average American worker when capital comes here. And so denying our workers access to capital so our capital can get access to better stuff outside the country doesn't strike me as something you should make your major policy priority. But there are people who disagree with that, so that's something you should seriously consider and is a different argument. Second, there are a ton of arguments having to do with sensitive technologies. I'm kind of skeptical that people are really going to get access to that much technology by buying into US companies. I sort of have a feeling that if you own a 4% stake as a passive investor in Facebook, I don't think you learn that much about Facebook's technology that you can't learn in a lot of other ways. If you really want to stop other countries from learning the cutting edge things that we have in the United States, you should think about what you can learn studying artificial intelligence at MIT and who has access to that. And I'm not sure you really would want to control that, but I'm skeptical that investments in companies outside of the national security sphere are really spreading that much technology. But that needs to be investigated more carefully, and I'm not so sure. I'm more worried about the infiltration of US networks. I don't know anything about Huawei, really. I don't know anything about other Chinese companies. But it does seem to me that where companies are very close to governments and where companies once present may be able to have enormous leverage over things that happen in the United States, it's appropriate for us to be careful. And I think that's an area where you might want to develop some new guidelines. And finally, I think there are issues that require thought about what might be called partial cross-border nationalization. You know, we allowed, and it was probably the right thing to do. I think I would have supported it if I had been in government at the time. We allowed foreign governments to make major investments bailing out our financial system in 2007. And we allowed foreign governments to have 5–10% shares in some of our major financial institutions. What should the rules for those be? Are those an appropriate subject of government-to-government dialogue? Should we be willing to accept being lobbied by the ambassador from Abu Dhabi or Singapore about our policies towards those financial institutions? What should our view be? We don't really have the leverage to stop it, but should we be a little bit uncomfortable about Norway deciding that it's going to own all our stocks except Walmart? And should that be something that is part of our commercial diplomacy? I mean, if Norway put a tariff on products from Walmart, we would engage with them very aggressively. If they make a decision to single it out for divestiture on political grounds, and we think it's an uninformed decision because they're not understanding our labor practices properly, and Walmart would like the US government to involve itself in that issue because it's, after all, a government-to-government issue, what should our policy be? I think that's a question that we should reflect on. So I think a nationalist hostility to foreign investment as a policy, Mr. President, is unwise, but I do think that these upswings in foreign investment do raise a number of issues that your administration should consider. Larry, shouldn't we really get these companies to run themselves right? I mean, it wasn't like Say on Pay, a fantastic bit of legislation. Wasn't it really a great idea when we required that they report the ratio of pay to wages, CEO pay to wages? Should we really be letting those Google guys and other guys like them say that none of the other shareholders get a vote and they get to control the company forever? Look at Sumner Redstone and what he's doing, and he doesn't even know what's going on. Shouldn't we have some corporate charters that make all these companies act right? And Wouldn't that be something we can do that would strengthen and stimulate the economy without having to blow up the federal deficit, which you're always yammering at me is already too big whenever I want to do something constructive for the people? I mean, shouldn't we really get the corporations to do the stuff that needs to be done? You know, again, all these things need to be looked at, but I think you need to remember that the American corporation has been a remarkably successful institution. I think it's enormously important that you have strong retail protections of every kind for retail investors. But in general, letting wealthy individuals make contracts with each other as they see fit isn't something you should always do, but it's something where you should have a strong presumption that you're not going to overrule the ability to make contracts unless you have a very good reason. And a lot of the stuff can be quite perverse. You know, if you look, for example, at that CEO to average worker stuff you were looking at, some of the CEOs with the highest ratios have the lowest pay. They just employ a lot of people in Bangladesh, so their average wage is really low. What does that prove? If somebody figures out how to outsource all their food service and all their janitorial service, the world will get worse for ordinary workers, but their ratio will look more favorable. So I think we got to look at all these proposals in this area in a less emotional way. And we got to recognize that when government goes charging into these things, there often can be unintended consequences and perversities. But yeah, I think it is terribly important that we think about the structure of these institutions. And it's probably true that if war is too important to leave to generals, that corporate law is probably too important to leave to corporate lawyers or even to the SEC, and that we should have some broader set of economic reflections on these questions. So those are the questions that it seems to me a thoughtful president might ask about your broad areas of concern, and those are the answers that I would give as my best guesses. So I am happy to be told why any of my answers were stupid or wrong. I am happy to respond to any other question that you think a thoughtful president might ask, or I am happy to elaborate on anything I said. Anything I said that was smart is because I had read somebody in this room's paper or had heard about somebody in this room's paper. Anything I said that was stupid was because I was thinking about it myself. So the floor is open.
This is the quietest I've seen everybody today. Mentioned that, thank you, that is there a question about whether index funds should not vote? And I declare my interest. I'm from BlackRock. We have a lot of index funds. I've been in this world long enough to be here at a time when the big concern about index funds was that they didn't care, that they didn't vote, that they didn't pay attention to what management was doing, and that was called zombie capitalism. So I'd just be interested in your view on where that balance might be shifting today, because index funds are growing, which if anything makes their voice more important from our point of view, but there may be a counterpoint of view.
I'm not certain I understood the question. What I got from the question was there was a time when everybody worried that what was wrong with index funds was that they were zombie capital that didn't pay attention. And now there seems to be a problem that they're paying excessive attention and making everybody into a conspiracy. And where's the balance? And I guess I'm not sure that everybody has to pay a lot of attention in order to have a company be well run. And so if you said, if you are a passive investor who is not making a choice to hold a stock except by deciding that it's part of an index, that you should abstain with your vote. And that will save on your transactions costs, and it will cause other investors to be more heavily motivated to invest in developing thoughtful views, because their influence will be proportionally greater. That strikes me as being a potentially that strikes me as being a potentially good idea. And the current world where the people who run ETFs, this may be an unfair comment I'm about to make, but kind of seem to adopt a set of positions that are designed to pander to the political prejudices of elected state treasurers. And that constitutes their role in governance, and they're basically not driven by making the companies better or more profitable, but it's driven by doing things that will cause them to seem more attractive to fund allocators who have to offer defenses of what they've done to political officials. Doesn't strike me as being a particularly valuable or great thing. So if I was looking for a reform in this area, it would probably be in the direction of reducing the empowerment of index funds rather than increasing it. But I didn't mean to leave the impression that I'd regard it as a super high priority objective to disempower index funds.
I don't want to monopolize, but I do want to just make 2 points. Firstly, if we do what you say about just letting everybody else do the work, then we're a free rider, and that is not a good thing, as every economist in this room will tell you. That is a big challenge in this area. Second thing, state treasurers are not our clients.
Are not what?
State treasurers are not our clients. You know, we have a very broad spectrum of clients across the political universe, and we're global. We have a lot of client expectations put on us about what we do. The reason we do any of this is to enhance the value of our clients' assets. And that's what corporate governance is. It's about the quality of leadership at companies and the quality of management demonstrated by the management executive team. And that is what we're trying to achieve. And the way it gets portrayed publicly is often that this is about social or environmental or political issues. It's about financial issues. And that's what corporate governance is when it's done well.
I hear you. And I recognize that you are much, I don't know exactly what you do, but from the way you spoke, I assume you are much closer to this than I. I would confess to a certain amount of cynicism. My impression is that at least many institutions are highly responsive to the two agencies that run around evaluating corporate governance practices, whatever, ISS and Glass Lewis. No, I understand. Well, they're your providers, but the fact that you rely on them as providers, in my judgment, somewhat discredits the quality of your efforts. Since I'm in very little doubt that at least on some significant occasions, they are basically in the business of selling protection, that you hire their consulting services and you are kind of more likely to get a positive judgment of your practices. And I'm sure that if there's anybody from those institutions here present, I'm sure they will heatedly deny that that is the case. And I cannot claim to be immediately up to date, but I am in very little doubt that over the last number of years, there's been a certain amount of abuse along those lines. So it may be that the situation is somewhat better than I imagine, and it varies somewhat from institutions. I would observe that the largest institutional money manager in the United States has a CEO whose most frequent comments in this sphere are of the myopia, long-termism vision that I identified as implausible and evidence-free. And so that would cause me to have some doubts as to the contribution that institution makes to high-quality governance, and it is the largest.
This is not the point, but we're happy to come to your office and point out
Are you guys both from BlackRock?
Yes, and point out why we believe that a little bit of knowledge that you have on this subject is a dangerous thing.
I'm sure you do believe that.
We will not on long-termism. I'm not talking about long-term. I'm talking about governance and the vote. So we'll come and visit you and we'll explain it.
Yeah, I've spent a fair amount of time with Barbara, so I am able to do your side.
Well, you've misstated our side tonight, but that's fine.
I would be happy to. I would be happy to continue. I would be happy to continue the dialogue. There is a lot you all say about long-termism, and it has not noticeably improved in response to the comments that I have, in response to these kinds of critiques, and perhaps I'm wrong. I'm open to that. I'm entirely open. Absolutely. Good.
Right, Mr. President, I'm the new president.
I was instructed, by the way, to be provocative.
Don't worry.
I was instructed to be provocative, and the one question on which I'm absolutely authoritative is what my current views and instincts on this subject are. No, on all the subjects, the one thing I'm authoritative on is what I think. It may be wrong, but I have described to you what my current thinking is. Yes?
Well, I'm hoping to make you happy because I'm the new president. So the question is this. My predecessor forgot to ask you about your advice on globalization. I've got elected, although I know globalization is very unpopular, not just here at home, but outside the United States. So how, believing in, good economics, how do I make globalization and good economics popular with the voters?
I think the question, again, the acoustics here are not great. I think the question was, how do I make good economics popular with with the voters? Look, I think there are probably three parts of an answer to that. One is, I think over time, political leaders can find ways to explain things to people that work. It's not a small, we regard it as not a small thing that starting a few years into his term, President Clinton started talking in strong ways about the benefits to consumers of trade. He had previously argued it entirely sort of on mercantilist grounds. Trade means exports, and exports create jobs. And we got him to start talking about how your sneakers cost half as much because of international trade. And that was an important thing, and I think that did something to propel the case. So I think good arguments, clearly stated, have a fair amount to do with this. I think the second thing is that, and it goes back to the Constitution, not every decision should be a referendum. And there's a reason why we have an independent central bank, and there's a reason why we have independent regulatory agencies, and I think we need to think about ways of taking a variety of kinds of economic decision-making out of the immediate political fray, because it inevitably will be somewhat limited in its wisdom. And I think the third thing is there needs to be some broader set of efforts at economic education in the country, and that it ultimately makes a difference. And I think there are a set of things that economists do that are very controversial. What should the Fed do next month kind of stuff, or some of the questions we've been discussing tonight. But decisions should be made at the margin. Opportunity cost is important in the allocation of resources. Incentives matter. There are a set of things that almost all, a comparative advantage is important and supports the division of labor and greater efficiency. There are a set of things that almost all economists agree on, and we somehow need to make that be a larger part of the educational system at every level, or at least that's what I feel. Yes, sir.
It's not related directly to any of the topics you mentioned, but I wonder what you think about, you mentioned corporate America is remarkable, and I tend to agree, but it's also involved in politics quite a lot. We have revolving doors between regulators and corporations. We have money invested in politicians. Do you think that's a big concern, which maybe presidents can try to deal with?
The question was sort of, what about money in politics and revolving door, and maybe the corporations kind of own the system too much, and that's why we get bad outcomes. So I think the first thing I'd say is that a lot of the worst stuff isn't big money. If you sort of ask me, and I would guess half the people, at least half the people in this room would agree with what I'm about to say. What's the single worst bit of special interest stuff in America? I think many of you would agree with me when I say it's the NRA and the lack of gun control. And that's all small money. And if you thought about some other examples that are kind of terrible, There's all kinds of stuff about housing that's terrible. You know, title insurance. Why are realtors' fees so high and not really competed on? Why is there exclusionary zoning? There's a ton of stuff around housing that's really very bad. And most of that stuff is is small money. It's large amounts of small money. You look at a lot of the worst protection, sugar subsidies, milk subsidies, a lot of that stuff is not big money. By the way, Donald Trump raised less money than the Democrats did, and a lot of it was, probably a higher fraction of it, was in small money donors. So I think you have to be very careful in attributing, I mean, I don't like a lot of things about the Koch brothers, at least as much as you don't like them, but I think you have to be very careful in blaming the problems on money. Revolving door in regulation, there's some of that, but I actually, having sort of watched the process, I think it's got much more to do with what might be called cognitive capture. You know, you're a regulator and you spend every day for 3 years working inside of the JP Morgan Bank. It's kind of hard not to start thinking a little bit like the JP Morgan Bank when you do that. So I don't see a lot of evidence. I'm open to persuasion, but I don't see much evidence that of major decisions being made based on people trying to set themselves up to do well in industry after they leave. You know, I'm sure you can produce some particular counterexamples. I think there's a problem. I think there's a different issue in thinking about regulation. There's a very important issue in an increasingly complex world. And I'll take an example that's away from the expertise of all of us in this room. Regulating nuclear safety. So here's the problem. You kind of want people who regulate nuclear reactors to know about things nuclear and to really know a bunch about nuclear engineering. But if you really thought nuclear reactors were terrible and really unsafe and inherently unsafe, why would you get a PhD in nuclear engineering? Everybody who becomes an expert in nuclear engineering does it because they want to work for a nuclear company, or they want to be a professor of nuclear engineering and teach students about nuclear engineering, or because they want to work somewhere near nuclear things. Why else would you do it? And something similar is true with respect to derivatives. If you really think derivatives are weapons of mass destruction and nothing else, why would you spend your life studying and becoming an expert on derivatives? And so there's a deep problem, which is we want our regulators to be knowledgeable and informed about the stuff they regulate, and we want them to be way arm's length But it's kind of hard to be it's kind of hard to find people who are way arm's length and knowledgeable. And so, people sometimes think the answer to this is academics, but academics aren't really. I mean, academics who are knowledgeable about practical things tend to have some set of connections to those practical things that would operate to undermine their objectivity. So it's a real, genuine kind of problem, and I don't know quite what you do about it. I mean, you could, and it's sort of, there's a little more of this in some other countries, but you could believe in the theory of enlightened amateur. So you could take somebody like me, and you could say, well, you've had a bunch of experience in government, you are possibly thoughtful about policy, you don't know anything about telecommunications, so you're not co-opted. And so we'll give you an important responsibility with respect to telecommunications, and we'll say you're not allowed to go work in the telecommunications industry afterwards, and it'll be really objective because you weren't co-opted before and you can't be co-opted after. Of course, you don't know anything about it, which kind of seems like a fairly serious problem. So I think that a lot of the problems people worry about in regulation have more to do with that than they do with the perverse effects of campaign big money. Any other? Thank you so much. Wait, one more. One more, sure.
Yes, I wanted to know your opinion about the rise in market power, the rise in markups in U.S. corporations. Do you think that this is a first-order concern for the U.S. economy?
The question was, do I think the increase in markups and market power is a kind of first-order concern about the U.S. economy? If in my little speech I had posed one more question, it probably would have been that one. And I didn't pose it in part because my beliefs were kind of on the one hand on the other hand. It does fit a variety of facts. There's more profitability, there's higher profits than there used to be, there are more companies with Q ratios substantially greater than 1 than there used to be. If you have more monopoly power, then you'll have more people restricting investment and restricting hiring, and there's some evidence that's going on. So I find it fairly plausible. On the other hand, do I think what is it being caused by? Is it being caused by the fact that for a variety of reasons, the best firms are better than mediocre firms than they used to be, and therefore earn higher margins, but it's not because they're competing unfairly, it's just because they've got more advantage. If you go from all the bookstores being equally good to 2 of the bookstores figuring out how to be much more efficient bookstores, then you'll observe more profits and more indicia of market power, but it'll be a kind of consequence of successful competition rather than a consequence of a failure of competition. There's an old University of Chicago idea that sophisticated economists have shown not to be universally valid in 13 ways that still seems to me to have a bit of validity, which is that if you're trying to decide whether a merger between A and B is monopoly or is efficiency, ask what C, who's in the same industry, thinks. And if C likes it, then it's probably monopoly. And if C hates it, then it's probably efficiency. And I see more complaints coming from competitors in general than I see coming from customers. And that makes me kind of skeptical. I look at U.S. without really knowing a lot what I'm talking about. So, I mean, this is an even more tentative judgment than some of the others I've offered. I kind of look at U.S. telecom and cable TV rates, which seem pretty high relative to what they are in Europe. And I ask myself, is that because it's more competitive in Europe? Or is that because there's more redundancy being paid for in the U.S.? And I think more redundancy being paid for in the U.S. is probably the more plausible explanation. And that makes me a little nervous as to whether it's really a terrific idea to have four cable companies, four telephone companies, mobile telephone companies, rather than to have a smaller number that are more extensively regulated. I ask myself, do I really deep down believe that Amazon is going to somehow become a huge monopolist and rip us all off? Or do I believe that Amazon is disciplining pricing in a quite pervasive way across large numbers of retail industries and is basically serving a pro-competitive function? So I think the answer is that I worry a little bit that there are some things happening that produce more monopoly power, but I sense that many of the things people would want to do about it would end up being protecting weaker competitors from stronger competitors, and would ultimately not be in consumers' interest. But I think that's not an answer in which I have, of the various judgments I've expressed, there's some where I could sort of rank them by how likely I thought I was to have an entirely different opinion 18 months from now. And that would be one where I think I'm more likely to change my mind than some of the others. Though, of course, on the question of just what exactly the role of index funds should be in governance, I will be entirely open to persuasion. Thanks very much.